Friday, November 18th. I'm Dave Weisberger, and it's time for This Week in Crypto, otherwise known as my weekly rant about what's going on in crypto. I'm going to break this week into three pieces. The first, a quick look at the markets. Second, we're going to talk about cognitive dissonance and what's been happening in the whole FTX saga as it's unfolding. And then third, I want to zoom into an interview that Gary Gensler did, which points out exactly what is flawed with his approach. That interview was literally just over a week ago. I could have, I suppose, talked about it last week. Let's talk about the markets first. Bitcoin, boring. That in and of itself is interesting. Bitcoin is basically flat. I think it's down less than 1% over the last week. The stock market is down. It's around the same as it was about a week ago. Not a whole lot of movement there. Ethereum is down a bit, like 3 or 4%, but on a global scale, compared to this massive onslaught that we've seen with FTX going under, Genesis, the largest lender in the space, halting loan origination. Honestly, that's a pretty good result. I attribute it to a few things, and there's a few things that are going on that are worth understanding, making me think that we're finding and in the process of building a tradable bottom. Not sure we're there yet, but it's certainly getting there. First, the Bitcoin hash rate continues to be at an all-time high. While that's awful for miners, because the degree of difficulty keeps going up and the competition is obviously higher and the Bitcoin price hasn't rallied, it's extremely hopeful in terms of the overall prospects of the Bitcoin network. The second thing that's interesting is as a percentage of Bitcoins on exchanges, the amount of supply to be sold is basically getting close to lows, certainly cycle lows, and we haven't seen anything like this since 2018. That's kind of a big deal because the selling pressure that one might think would happen, there's not a lot of coins to sell, and that matters. It also means if buyers come in, there's not a lot of coins to sell to those buyers. Now, there's obviously leverage going on and other things, but there's also been a massive deleveraging. The collapse of FTX, which was one of, if not the most relevant leveraged venues, particularly for market professionals, is relevant and probably decreases a fair amount of selling pressure overall. At least that's sort of what the market is telling us. So the only other thing that we see that's gone on in the market is, with the coins moving off Bitcoin, is an increase in self-custody for sure, an increase in DeFi volumes, which is why CoinRoutes is pushing so hard into DeFi, starting with UIDX, but other distributed exchanges will be adding. It's something that's a major focus for us because our clients want safety. And not your coins, not your keys may not be everyone's cup of tea, but it's certainly important. So let's talk about the word of the day or the phrase of the day when I look at the FTX situation. And that's something we call cognitive dissonance. Cognitive dissonance is a communications theory that basically says that human beings tend to rationalize one thought with their actions. So if you have been a supporter of Sam Bankman-Fried, if you have believed in many of the things that he's said, whether it's on the political side, effective altruism, or like me, believed in many of the market structure innovations that FTX had done, your brain wants to reconcile that with the evidence that you now have in front of you that he orchestrated one of the largest thefts of assets in world history. And that is hard to do. But for some people, it's harder. So the fact of the matter is we've had the New York Times. And the New York Times has written nice things about him because, well, he donated to their political party. So, okay, they do that. Other outlets are writing nice things about Caroline, who was, if anything, based on her blogs, a degenerate gambler. And I talked about that last week at length. I'm not going to reiterate it here. But let's just say that doubling down is not a winning strategy. But what bothers me the most right now is that FTX did have good ideas. The idea of a multi-collateral, real-time risk liquidation engine is the right idea. Now, of course, they withdrew their filing with the CFTC for obvious reasons. But the truth of the matter is that is a better market structure, and I do believe that. What was interesting this morning on Twitter, people were talking about how it's such a bad market structure, ignoring the two flaws that really are why it didn't work in this case. Flaw number one being that they turned it off for Alameda. Well, that's ridiculous. You have one of the largest, they're one of the largest creditors, probably the largest exposure to them, and they turned off the risk engine. So of course, well, if you turn off the risk engine, things aren't going to work. The other thing is they accepted collateral, such as FTT, without haircutting it for its liquidity. Well, when there's $60 million worth of freely floating cap, and you have $2 billion of it as collateral, that's beyond a problem. That's orders of magnitude incorrect in terms of where you should have valued the collateral. So that's a big deal. If you put all of this stuff together, what you end up with is understanding a crime on the scale of Bernie Madoff, of Bernard Evers at WorldCom, of Skilling at Enron, maybe all of that wrapped together, where essentially you had billions, potentially over $10 billion of losses from Alameda, from a firm that basically started as an arbitrage firm, continued as a market maker, and then moved off that path to taking bigger and bigger and bigger bets over time. And that, in particular, being used to fund customer money, is a theft on a massive scale. Basically, what you have is customer money being used without disclosing to the customers or even the ability legally to do it, funding a gambling addiction. And that's what we had. Does that have anything to do with crypto market structure? No. So what should we learn? Well, there are a few learnings here that are important. The first one, custody as it applies to crypto exchanges should be in a completely separate, auditable part or totally separate entity. Having that attached to anything that is taking risk, anything that is making bets, is a very, very bad thing. Having it done so without any audit is even worse. Second, combining risk-taking with agency businesses really takes care. In the world of traditional finance, it can happen, but it's with very strict information barriers and surveillance by regulators, both on the spot, out of the blue, and also scheduled examinations. In this particular case, nobody ever examined them. And there's also need for U.S. rules that deal with things that are investments, such as the Securities Exchange Commission or the CFTC, to work with crypto venues to make rules that actually work so that they can comply with them. FTX was regulated, I think, by 12 different entities between MTL licenses, MSB licenses in the U.S., and other geographies. Yet none of these regulators, none, ask the question of where does the money come from? Show accounting, show accounts. It's actually mind-boggling that none of the, quote, regulators did anything to do with protecting client assets. So that's an issue. Obviously, we want to see regulation, but we want to see it in a way that doesn't destroy the businesses. Which brings me to our good friend Gary Gensler. So he gave an interview with CNBC that was fascinating. The first thing he did is he actually said things I agree with. He said, you shouldn't mix customer money without disclosure and leverage together. I agree. Absolutely right, Gary. He then says that crypto markets are very interconnected. The lenders are connected to the leverage takers, to the market makers, to the customers, etc. Once again, I agree, Gary. And the reality is some of those interconnections are okay if surveilled in the appropriate way. But what's really important about that second sentence is it proves what I accused him of last week. He knew that causing a massive increase in the Grayscale Trust discount would be interconnected and have massive effects on the crypto ecosystem. It's amazing he actually admitted it, but he did. So he knew that. So my accusation, which says that he understood he was going to cause stress and didn't care, is pretty much proven now. But he then goes on to say a couple of very interesting things. He talks about the fact that investors need protection. Once again, I agree with that. And then he says, but all the industries are non-compliant and regulations are clear. Well, that's true. The regulations as they currently exist would shut down all of crypto and destroy all the investors that have invested in crypto and in those companies. So he kind of ignores that fact. That's kind of important. But then he talks about that he has multiple possible paths. And he talks about two in particular. One, which actually makes sense, and one that's insane. Guess which one they're doing. The first path, he says, we could work with crypto exchanges to draft rules and to work with them to help them to become compliant. And then he goes silent on that because he knows that nobody's willing to talk to him because they understand that he's going to do the second thing he said, which is secondly, we could do enforcement. And then he starts to raise the flag and say, yeah, and we had a big win, his words, not mine. In the scope of FTX, a big win because they got to get the judge to say that library, LBRY, a token that pretty much nobody outside of the bowels of the deep bowels of crypto even knows what it is, was called a security, and therefore he could shut them down. Now, not protect the investors in library, mind you, but shut them down. So he considers that a big win. Basically, what he is telling you with his words is that a win to Gary Gensler is more jurisdiction and the ability to harm more investors in crypto to bring it under his thumb. A big win isn't getting surveillance to protect investor assets, working with crypto firms to help them create a protection for investor assets, for example, in the case of bankruptcy, or to create some notion of being able to segregate funds, or to actually have a path to compliance, as Hester Peirce has often said. What's funny about that is I went back to my archives, and in 2018, I actually met with the SEC. And I'm going to produce this on our blog again. But in that particular presentation, I said a bunch of stuff. Most notably, I talked about how all current exchanges that trade tokens deemed securities should be granted a grace period to apply to become alternative trading systems. And I said, without a grace period, investors could suffer serious harm as asset prices fall when they have no place to trade those assets. That's something I said literally 4+ years ago, almost 4.5 years. It is still true today. It's sad, but we have an SEC chairman who, while he understands that that is true, doesn't care who he hurts. So, what have we learned? Where are we? There are multiple dominoes that are probably still yet to fall. The fact of the matter is, FTX did have some really, really good ideas. They were the most capital efficient exchange because of cross-collateralization. They did have arguably one of the best platforms and easiest to use platforms. They did integrations and made it simple for people, and they were the choice of the professional market. That, coupled with the fact that they're gone now, is problematic. So there are many market makers that aren't there. But the one thing that I will report is, looking at the data, we are seeing fairly significant improvements in liquidity. Many of the market makers that stopped, or at least others have replaced, now when we look at the Bitcoin pricing, the Bitcoin order book is probably filled in about 75% of the average liquidity that you would expect on the order book compared to where it was. Now, it was down significantly. It still has not fully recovered, but it is recovering. Time will heal, and a good idea will continue to attract capital. And I'll leave you with that for this week. Take care. Have a great weekend, everyone.